All right, hey everyone, Scott Tolar and Kim Tarver here, and today we're going to go over some additional portions of, or additional addendums for the 1 to 4 family residential contract, and we're going to start with a third-party financing addendum. So Kim, let's go ahead and jump on into it. At the top here, it says something really basic, street, address, and city. What do we put there?
The street address and the city.
There you go. You see, and it doesn't have to be the legal description on this
That's
one
right.
because you've already covered that on the 1 to 4 family contract already. This is just giving you reference to that contract, and keep in mind, on the contract itself, you already checked the boxes saying that this does go with the contract. So let's go ahead and go straight into it. Box 1 is type of financing and duty to apply and obtain approval. So what does this mean?
Well, the first thing I want to say about this addendum is a lot of times they're saying they're getting a signature loan or a hard money loan, or something to the effect. Any kind of loan at all, if you've had to write the contract showing a loan and you've checked the box third-party financing addendum, like if it's on a manufactured home, you still have to use this. If you check the box, you have to use this.
Exactly.
So what this means is that this addendum is telling the seller how they are going to obtain financing.
Okay.
What type of loan they're going to get and how quickly they're going to obtain financing.
Got it. Okay. So let's just go straight into the first one, which is under paragraph 1, box A, conventional financing, which if you check box number 1, it says a first mortgage loan and the principal amount of blank. So what would you put there?
So whatever is in B on page 1 of the contract,
all right,
that's the amount that goes there. So that's the actual loan amount. And use conventional financing if it's not an FHA VA or it doesn't have another box. You have to use conventional financing.
There you go. So remember when we did that A plus B equals C, this time you're just using the plus B portion. So whatever's in B is going to be the amount that you need to put there. And then it says excluding any financed PMI premium due in full in, we're seeing 30 years.
Typically
that's
30.
Typically what you're going to see.
Typically 30.
Now occasionally if you have a client who's going to want a 15-year or even a 10-year, it is possible to do that. So just make sure that you've spoken with their lender or you've looked at their pre-approval or pre-qualification letter to see exactly what the terms that have been put on that are. And just a point of clarity, it's best to always reach out to the lender and verify anything that's on that piece of paper. So there we go. And then with interest not to exceed, what do we put here?
Well, your pre-qualification letter, pre-approval letter will have the interest that's on there.
Yeah.
But remember, your buyer can't lock until there's an executed contract.
Correct.
So if the interest says 2.75, I would probably put 3% just to pad it, just so you didn't have to go back and renegotiate the addendum.
Yeah, so give yourself a little bit of room there because, right now in everything that we have going on, we're seeing interest rates decrease. And if you had told me a few years ago that I'd ever say the words 2.75% on a 30-year fixed, I would have laughed at you and told you you're crazy. Yet we can say that today. So take advantage of it while you can, and know that you need to give yourself a little bit of a buffer up there, because I have seen it before where all of a sudden people could back out of the contract based upon what their rate was going to end up being, gave them an additional out. So give yourself a buffer there.
Because remember, whatever you put in here, the buyer has to be able to qualify for that, or they do have a way out. So even as a listing agent, it's still important that you make sure this matches your pre-qualification letter.
Correct. And then it says per annum for the first, once again here you'd put 30 years. And then of the loan origination charges as shown on the buyer's loan estimate for the loan not to exceed. What do you put here?
Usually put 1% there. In a seller's market and low interest rates, that's what you put here.
There you go.
So different time, we'll do a different video.
Exactly. For now, go ahead and on average you're going to see 1% there. Sometimes you will see other agents bring you an offer with different amounts there. It's nothing to be alarmed at. If you have questions about it, just come and see Kim or myself or call our contract hotline. All right, and then box number 2, a second mortgage. What the heck is a second mortgage, Kim?
Well, a lot of times when a buyer only has 5 or 10% to put down, but they don't want to pay your private mortgage insurance, then they will do a second mortgage to pay the rest of the 20%.
Okay.
which is paid off usually in 10 to 15 years.
Got it.
And so that would be the second mortgage. However, right now with interest rates as low as they are, we're not really seeing many of them.
Yeah, so usually if you had the rates back, what we had like a year ago, 4.625, something like that, it would be a way for people to have the ability to make it appear as though they were putting additional money down so they didn't have to have the PMI, and they were really just getting a second loan for that. A lot of times you could do an 80-15-5, you could do an 80-10-10.
Yeah, and it's very common when the interest rates get higher.
Exactly. So just keep in mind that that's something that you could very well see. And if you have questions about it, once again, come and talk to us. All right, checkbox B, Texas Veterans Loan. What in the world is that?
A Texas veteran loan is just for Texas vets.
Okay.
It's exactly what it says it is.
So you have to be born and raised in Texas in order to get that loan?
No, you just have to be a Texas veteran.
Okay, so you have to live in Texas.
You have to live in Texas and be a veteran.
Okay.
Absolutely.
Great.
Absolutely.
All right. And that's, once again, here, it's going to be for the amount of years. What amount of years are you normally seeing on a Texas vet loan?
Normally on a Texas vet loan, people do it on land.
Yes.
Yeah, and they usually do it about 10 years.
Okay.
Sometimes 15.
Yeah, so, and that's just going to be right there. You only put in the amount that you're getting the loan for and the amount of years, because the interest rate is already established. There's no questioning what the interest rate is going to be. The Texas Veterans Land Board determines exactly what the interest rate is going to be there. All right, so paragraph C, one of the ones you're going to use a lot is FHA insured financing. So a section blank FHA. Now, are there different sections of the FHA? There are.
And the typical one that you see is a 203B as in boy.
Okay.
The only other one that is typically used would be a 203K as in Keller.
Okay.
Which is anytime you are working in repairs into your note.
Got it.
And not every lender does 203Ks.
Yeah.
Most of your lenders will do 203Bs, and that is the most common. If you're writing any other kind of FHA, you need to come see one of us.
Yeah, exactly, because in the world of HGTV that we live in, where people go and look at homes that were built in the 1950s and think, hey, I want to rehab that home. I think that's perfect for my wife and I, and it's going to be an amazing home for our first home. And we're going to have to rehabilitate the whole thing. And then they look at their bank account and realize, oh goodness, I don't have any money to do the rehabilitation. There are unique special lenders out here who do 203K. And remember, there is going to be work that needs to be done on the front end. You're going to have to get estimates. You're going to have to get specific quotes. You're going to have to almost provide them with every single item that's going to need to be purchased and what the price of all those items are so that you can qualify for those things.
And the appraiser typically has to go back out 30 days after closing just to make sure the work's done.
Yeah, to make sure that you did it and you didn't just, pocket the cash. Not you, but your clients. And we know that you don't work with any clients like that, so we won't worry about it.
I was built in the 60s. I need a rehab.
Well, there's doctors for that. I don't think you're going to be able to qualify for a loan for it, though.
Darn.
Okay, all right. So then, once again, you go back into it. You're going to put whatever you put in box B there in the contract for the amount of the loan that you're going to get. And then, once again, 30 years. And then with interest not to exceed the certain amount of percent there. Now, on an FHA loan, keep in mind, the interest rate percent is typically going to be a little bit higher than what your conventional loan financing amount is, because it's a federally backed loan. And then with interest not to exceed what we just talked about per annum for the first 30 years, and then of the loan origination charges as shown by buyer's loan estimate for the loan not to exceed blank percent of the loan. Once again, you're probably going to see 1% in here once again. So anything you want to add to that?
No, just keep in mind that FHA loans always have MIP.
Yes. And it's something you can't get out of. The only way to get out of the mortgage insurance is to refinance your home.
Or get an appraisal and prove that you've paid in and you only owe 80% of the value of the home.
That is one way you can do it. That is one way you can do it. It used to be where after 10 years it just fell off. But that's not the case anymore. There have been some changes that have been made so it doesn't just fall off. And if you want to get the appraisal done, you're going to have to pay to have that appraisal done.
Yeah.
Okay, so let's go with VA guaranteed financing. So this is another veterans financing
It
thing.
is.
What are some things that that are on here that you need to look out for the VA guaranteed loan?
The VA guaranteed loan runs very, very close to the FHA.
Okay.
And the old stigma where the VA loan costs the seller more is over. So
Good.
It's the easiest loan to get, and we highly recommend that you get as many of them as you can. But keep in mind that you're financing with VA, you can put 0 down. So it could be that paragraph A of page 1 of your contract is going to show 0 down, and then show the offer price as the loan amount.
Correct, yeah. And keep in mind that for VA financing, the interest rate actually can also depend upon the amount of disability that the veteran has. So, for instance, if they are 100% disabled, I actually recently heard about somebody getting a 30-year fix, and man, you get goosebumps about this, but a 30-year fixed rate at 1.75%. Because when they account in for their disability and everything like that. And remember that for the municipalities in the state of Texas, for taxes, they take into account the amount of disability a veteran has as well. So if you have 100% disability, you could be paying no property tax. And they do it based upon the amount of disability. So that's something to make sure that you're educating your clients about. And when they have questions about that, they can reach out to the local tax appraisal district and get that process started with them. It's not something for you to take care of for them. It's something for you to address that they have the ability to look into with their local tax appraisal district. All right, let's go on to USDA. USDA, what in the heck is USDA?
USDA is a loan that runs very similar to a FHA.
Correct,
So-
but it's not a federally backed loan. It's still a conventional loan, right?
That is correct.
Okay.
That is correct. So who qualifies for USDA?
Literally anybody.
Good answer.
Anybody can qualify for a USDA loan. Keep in mind that the USDA loans are designed to help bring communities up. So you're not going to find a USDA loan in the middle of Fort Worth. You're going to have to go to the outside communities. You're going to have to go down into Johnson County. You're going to have to go up north. You're going to have to go. You're going to have to go west in order to find places that qualify for USDA. And you know, usually you're going to see big signs out in front of new home neighborhoods that say USDA eligible. Or you can buy a home for 0 down here, and those are things to look at. Once again, you're going to follow those boxes here. You're going to put in what you would in the contract, interest rate. You're going to put what you're quoted, and then per annum for the first 30 years, you're going to put that same amount there. All right, so then let's go on to reverse mortgage. What do you have to say about reverse mortgages?
Don't do it. Okay, I say that.
Yeah.
They have really
circumstances.
revised first reverse mortgages, and there are actually times that they are very good and they don't really leave you or your family in the lurch.
Yeah.
But if you're going to do a reverse mortgage, please make sure that you've talked to the lender and to one of us.
Yeah, absolutely. And not every lender does reverse mortgages. You've actually really got to know what you're doing in order to do reverse mortgages. So like Kim said, come and talk to us, and we'll make sure that you're in contact with the right people.
And we
do
have a preferred lender that is doing them now, and they're a more positive reverse mortgage, so they are not nearly as unregulated as they used to be, so they can be a good deal for some people.
Exactly. All right, let's go on to paragraph 2. That was just paragraph 1, believe it or not. Paragraph 2, approval of financing. So what does checkbox A mean where it says buyer approval?
Okay, so buyer approval is just how long it's going to take the lender to approve the buyer.
Okay.
Has nothing to do with the property. It is strictly just verification of financing, verification of employment, credit report, everything that's needed to approve them to carry them on.
Okay.
So it has nothing to do with the property, nothing to do with the appraisal.
So if it doesn't appraise or anything like that,
it has nothing to do with that.
Checkbox A has nothing to do with it.
That is correct.
Okay. All right.
That is correct. So how many days do you think should go in here?
You know, I've heard all kinds of things, but the most common number that I see, Kim, I think somebody one day just pulled the number 21 out of the air and said, hey, that's the number that should go in.
However, a savvy listing agent's going to want it in 14.
Yeah.
So whenever your buyer goes in for loan app to get that pre-qual letter, don't let them stop. Make sure that they're moving on and really going on with getting the loan, so that when a listing agent comes back and says 14 days, you can say not a problem, we'll have it in 10.
And remember that a lot of you guys are still talking about the fact that you're getting multiple offers on properties like that, and a lot of you buyer's agents out there are complaining and pulling your hair out because you can't get an offer accepted. This can be a point of leverage for you if you've done the research and had the conversation with the lender about how long it'll really take. Because if you don't need to put 21 in there, don't put 21 in there. Put the most amount of days that the lender tells you, hey, worst case scenario, I think this is how many days it's going to take. And if you feel like you need to give yourself a little bit of a buffer, you can. Obviously, have that conversation with your buyer to make sure they're okay with that. But the less days you put in here, the more advantageous it is going to be for you in a multiple offer situation where you're representing the buyers. Because a listing agent and their clients are going to look at that and say, okay, well, this offer is maybe $1,000 higher, but they need 21 days, and these other people just said they could get it done in 10.
Big difference.
That $1,000 is totally worth it right there for a lot of people. Okay, so then let's go, and then you would check this. You would check this property is, and then you put the amount of days, and then on the second page is the optional checkbox of this contract is not subject to buyer obtaining buyer approval. Now, what circumstances would you use that?
Whenever you've had a buyer that has actually gone through the entire loan approval process, and the underwriter has approved everything, they just need an acceptable appraisal, then you can check this box.
Correct. They need an acceptable appraisal attached to an address.
There you go.
Exactly.
There you go. So, but don't check this unless you're absolutely sure that nothing could go wrong. If you have a multiple offer situation and you can check this box, you usually go to the front of the pile. Yeah,
exactly. It's your get out of jail free card.
That's right.
All right, paragraph B, property approval. So this is the part where it talks about the property, not the buyer itself.
That's it. So the lender determines the property does not satisfy lender's underwriting requirement for the loan, including but not limited to the appraisal, insurability, and required repairs.
Okay, let's go to insurance for a second. So if I have XYZ insurance, and XYZ insurance goes out, they take a look at the roof and say, look, I'm sorry, we cannot insure that home. Does that mean that under this paragraph right here, I'd have the ability to get out of the contract because XYZ insurance said that they couldn't insure it?
If the lender will allow it.
Okay.
Usually you can go with whoever the insurance company is the seller currently has, and they're going to underwrite the insurance. So if you ever have that come up, it just depends on what the lender is willing to accept and what the lender is willing to do with it.
Yeah. So if it doesn't appraise, then based upon this, it looks like a buyer could argue that they have the ability to get out of a contract.
Absolutely. And buyer has no later than 3 days before closing to terminate the contract if they've given the seller notice and provided a copy of the survey. So no longer is a letter or an email from
the survey. You mean the appraisal?
Over the appraisal. Yeah. Sorry. No longer is an email or a letter from the mortgage company acceptable. It has to be the appraisal.
So none of that fake news stuff.
None.
You got to have facts.
No fake news.
There you go. Okay, perfect. Let's go on to security. What in the world does this mean? Paragraph 3.
Well, it's just like whenever you were in college, you had to rent an apartment, so you had to put down a security deposit. So each note for the financing described above must be secured by a vendor's and deed of trust lien. So that's the lien on your property. It also tells them how they'll foreclose if you don't make your payments.
There you go.
If you don't pay, you don't stay.
There you go. Okay, let's go to paragraph 4. This is FHA/VA required provision. Why would there be something like that on here?
Because on government loans, you are protected if the house is not appraised.
Okay.
Within the third-party financing addendum.
Now, in this blank right here, what goes in here? Paragraph. What's in B of the contract, or what's the entire loan amount going to, or what's the entire purchase amount going to be?
You mean C of the contract?
C. Yeah.
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 You know, it could be either.
Okay.
If it's FHA or VA, they really want it to be the actual sales price.
Yeah.
And however, if the buyer says, you know, I can throw $10,000 at it if it doesn't appraise, and that's how much the down payment is, then you can go ahead and put the loan amount there and have it work too.
Yeah, and usually...
Don't recommend it.
Yeah, I wouldn't recommend that either. Most of the time what you're going to need to put in here is the full price that you have in the contract that you're actually purchasing the home for, not just a loan amount, okay? All right, and then authorization to release information. This right here just says that they can release information to the person who's representing the particular party. So if you are representing the buyer, this gives you permission to speak with the lender. If the listing agent is representing the seller, gives them permission to inquire about it. Now, keep in mind right here what it says: buyer authorizes buyer's lender to furnish to seller or buyer or their representatives information relating to the status of the approval for the financing. Now, here's what I take this to mean, Kim. I take this to mean that you have to have proven that you are the representative to that person, which means that you should have a buyer representation agreement or a listing agreement showing that you are representing that party. So those are not just important because they guarantee that you get paid. They are important because it references a representation agreement right here on the third-party financing addendum, which gives you the ability to go and have actual conversations with the appropriate party.
And notice it says status, not details.
Exactly, status, yeah. That's important right
Yeah.
there. Yeah, you can't go and be like, hey, you know, I need to know all the details about what's going on with this. You can try, you can ask the question. They should not be giving you the answer about all the details. They can just say, hey, look, looks like we're on track, or we're not really on track.
That's right.
There you go. All right, anything you want to add about the third-party financing addendum?
No, but you have to use it if you check it on page 1 of the contract. That's one of the biggest things that Deborah kicks back compliance on.
It's on page 1 of the contract, and it's on page 8 of the contract?
8 of the contract where you check under.
Where you check the addendums. There you go, perfect. All right, we'll see you on the next one.